Welcome to the Deep Dive. Today we are digging into the Q3 2025 earnings call for BW LPG.
Yep, they're one of the biggest names in the VLGC space. That's very large gas carriers.
And their latest report was, let's just say it was a real head-scratcher for the market.
It really was. I mean, this is a textbook case of a company with fantastic operational strength just colliding head-on with some really volatile accounting.
Which, of course, led to a super confused and, well, a very negative reaction from investors right out of gate.
Exactly. We're looking at numbers that dropped pre-market on December 2nd. The stock sold off almost 6.5% right away.
Wow.
But if you listen to management, they framed it as, incredibly resilient. So we need to unpack the segments to figure out why the market panicked when the revenue numbers were so strong.
Okay, so let's start right there with those conflicting headlines, because contradiction is just jarring.
It is.
You look at the top line, and BW LPG delivered a massive beat on revenue.
Huge. Total revenue was about $280 million. The consensus on the street was, what, $243 million?
So a 15% beat, that's not small. And shipping revenue was up something like 27% year over year.
Right. So if you only saw that number, you'd think the stock was about to soar.
But it didn't, because the investor focus went straight to the bottom line, the EPS.
Yep, the GAAP earnings per share. It came in at 38 cents, but the market was expecting 57 cents.
So a 33% miss, that's a big deal. The market always reacts to that headline number first, doesn't it?
Always. Even if there's a good explanation for it.
And then the dividend, which is, the bread and butter for a lot of people in this sector, that just made things worse.
It really amplified the disappointment. They declared a 40-cent dividend per share.
Which is based on 75% of the profit from their actual shipping business, right?
Correct, the shipping NPAT. But the problem was that 40-cent number was about 31% lower than what everyone was expecting.
So you have this perfect storm, amazing revenue, a terrible EPS miss, and a dividend that felt light.
And that just creates total uncertainty. Investors just assume the momentum is gone, even with that great top-line number.
So that's the puzzle we need to solve, this massive gap between the operational success and the financial optics.
Exactly.
Okay, let's unpack that operational reality first. How strong is the core shipping business, really?
Look, the core business is an absolute machine. It's incredibly profitable.
Give me the numbers.
For Q3, their TCE income, that's the time charter equivalent, was $51,300 per available day.
$51,000. Just to put that in perspective for everyone, is that good in this market?
It's world-class performance. Absolutely world-class.
Yeah.
Especially when you see their cost structure.
Okay, but I did see it was actually a little bit below their own guidance. They had guided for $53,000, right?
That's right. It was a little bit shy of their forecast, yeah.
So why the miss? Was that a sign of weakness in the freight market?
Management was very clear on this. They said no. It was basically two things. First, they held back a bit on fixing ships in September and October when things got volatile.
So they chose not to lock in lower rates.
Exactly. And second, there was a negative IFRS accounting adjustment of about $7 million that dragged down the TCE number.
Wait, an accounting adjustment hit their main operating metric? What was that about?
It's a technical thing. It has to do with how revenue and costs are recognized across different reporting periods. The key takeaway for you is that it was a paper hit, not a real-world loss of cash.
So it made the operations look just a little bit worse than they actually were.
Precisely. The cash they earned was stronger than that headline TCE number suggests.
Got it. Okay, so what about looking forward? Because that's where you see the real stability.
Absolutely. This is where the story gets really compelling. Management gave some great guidance. For Q4, so the current quarter, 91% of their days are already fixed.
And at what rate?
At about $47,000 a day. Now, you have to remember, their all-in cash break-even is just $24,600 a day.
Whoa. So even at a slightly lower rate than Q3, they are locking in over $22,000 of pure profit per ship per day.
It's a staggering cushion against any volatility.
And they're locking this in for the future too, right? I saw numbers for 2026.
They are. 30% of their capacity for 2026 is already fixed at $43,600 a day. And they've hedged another 5% with FFAs at an even higher rate.
So they're building a really solid floor under their earnings.
That's exactly what it is.
Yeah.
And that kind of visibility is what big investors want to see.
Now, you mentioned the low-cost structure. What are the actual expense numbers?
Their daily operating expense, so crew, maintenance, the basics, is just $9,300 a day.
And the total break-even, including debt and everything?
The total fleet cash break-even is a very lean $21,300 a day. That's why they can generate so much cash when rates are up in the 40s and 50s.
But there is a short-term drag, right? The dry docking schedule looked pretty intense.
It is, and that's a headwind you have to factor in. These are mandatory maintenance periods where the ships are completely out of service. They had 168 off-hire days in Q3.
And more coming.
Yep. Another 121 days expected in Q4, and then a huge program in 2026 with 13 ships scheduled for docking.
So that's going to hit their utilization for a little while.
It will. It's a temporary hit, but a necessary one.
Okay, so the shipping segment is solid, but the market didn't sell off on dry docking. It sold off on that EPS miss. Let's get to the messy part. Product services, the trading arm.
This is the segment that caused all the accounting chaos. It reported a gross loss of $23 million.
Which turned into what, an after-tax loss of almost $30 million?
$29 million, yeah. A huge number from one segment.
What on earth happened? Was it just a bad quarter of trading?
It was almost entirely an external shock. Specifically, it was a negative mark-to-market valuation adjustment, a big one.
Okay, slow down. Mark-to-market. Let's break that down for everyone. What does that actually mean?
Okay, think of it like this. Their trading arm buys and sells future cargoes of LPG. If they own a position, they have to value it on their books at the current market price, even if they haven't sold it yet.
Oh.
In October, Saudi Aramco announced a surprisingly low contract price for their LPG. The moment that happened, all the future cargoes BW LPG was holding were suddenly worth less. On paper.
So they had to write down the value of their inventory, basically. By how much?
A staggering $32 million.
So it's like owning a stock. The price drops, and you have to record that paper loss, even though you haven't sold stock and realized the loss.
That is the perfect analogy. It's an unrealized accounting loss. The cash hasn't left the building. Management stressed this over and over on the call.
And that distinction is so important, especially for the dividend. So while that paper loss wrecked the EPS, did the trading arm actually make any cash?
Yes, and this is the critical point. Despite that optical loss, the segment generated a realized trading profit of $15 million in Q3.
So on paper, they lost $29 million, but in reality, they brought in $15 million in cash.
Exactly. And their year-to-date realized profit is now $54 million.
And why does that realized number matter so much?
Because that's what can be paid out as dividends, not the temporary paper adjustments. Management basically hinted that the board could distribute those gains after the year ends.
That $54 million is like 35 cents a share, isn't it?
Roughly, yeah. It's a huge potential catalyst that the market just completely ignored because it was so focused on the headline miss.
Okay, let's shift to the bigger picture. Balance sheet, strategy. They seem to be cleaning house.
They're in a great position. They have $855 million in liquidity. Net leverage is low at under 30%.
Yeah.
And they're so confident they're actually giving back some of their credit lines.
What do they do?
They voluntarily canceled 2 financing facilities. They paid back $36 million in debt. And get this, they trimmed $216 million of undrawn revolver capacity.
You don't do that if you're worried about money. That's a huge signal of confidence.
A massive one. And they're also selling an older vessel, the BW Lord.
Which will bring in even more cash.
Correct. That sale should unlock about $25 million in gains. It's just smart fleet management.
So if we connect all this internal strength to the macro picture, what does the market for shipping LPG look like right now?
The backdrop is still very, very constructive. It's all being driven by U.S. exports. The Permian Basin is just pumping out so much LPG.
And the other key driver is the Panama Canal, right? The logistical bottleneck.
That's the huge one. It's a major ton-mile driver.
Yeah.
The canal is still operating at reduced capacity because of the drought. The Neo-Panamax locks are only doing about 10 transits a day.
And container ships get priority.
They do. So a lot of these VLGCs have to take the long way around the Cape of Good Hope.
Which adds thousands of miles to the journey, soaks up fleet capacity, and keeps freight rates high.
Precisely. It's a structural tailwind that isn't going away anytime soon.
What about some of the risks, like the U.S. and China trade tensions?
It's still an overhang. Things are better than they were, but there's still that 10% tariff on U.S. LPG going into China. The market is kind of just absorbing that cost right now, but it adds friction.
And finally, the fleet itself. I saw the order book is 18%. That sounds high.
It sounds high, but there's an offset.
Yeah.
Management pointed out that 10% of the entire global fleet is now over 25 years old.
So those are prime candidates for being scrapped.
Exactly. So that demolition should absorb a lot of the new supply coming online.
So what's the long-term play here for management? They're not just riding the high rates, are they?
No, they have a clear strategy. They're aiming to lock in about 40% of their capacity for 2027 and 2028 on long-term charters. They're trying to de-risk the business and move away from being totally exposed to the spot market.
Okay. This is not financial advice. The part of the deep dive where we take all this data and pitch one outrageous but plausible trade idea. This is for entertainment, of course. Please do your own homework.
Given this huge disconnect between perception and reality, the trade is, I think, simple and aggressive.
Let me guess. You're buying the stock.
You long BWLPG right now. The argument is that the 6.4% sell-off was a complete overreaction to accounting noise. It's an irrational entry point.
Okay, but what's the catalyst? What makes the market change its mind quickly?
The catalyst is the Q4 surprise. The market is obsessed with that 19-cent gap miss from the paper loss. They're ignoring the fact that the core shipping business is locked in, making tons of cash at $47,000 a day for Q4.
So you're betting on a dividend surprise.
A dividend bomb, exactly. We're betting that management makes good on their promise and distributes that $54 million in realized trading profit.
Then you add in the $25 million from the ship sale.
You add that in, you put it all together, and you get a special dividend that completely blows consensus estimates out of the water. That forces an immediate re-rating of the stock, closes that 6% gap, and rewards anyone who saw through the accounting fog.
So to wrap this all up for you, what we saw this quarter was this central tension. You have a world-class shipping operation earning over $51,000 a day,
Just incredible performance.
masked by a $29 million non-cash trading loss that, frankly, doesn't affect their ability to pay dividends. The company's cash flow is strong, and its future looks pretty well covered.
Yeah, BWLPG is clearly moving toward being a more disciplined, integrated logistics company. They're using their balance sheet to de-risk. The big question for the next quarter is, can they prove that this trading volatility was just a one-time optical issue? Or is the market right that the good times for VLGCs are starting to peak?
The market seems to believe the latter.
It does. But all the hard data on their costs and their forward contracts suggests the market sold off on the wrong variable. You just have to decide, do you trust the accountants or do you trust the operators?